Welcome back, everyone. Glad to see you guys here. We are back with Joel. Today is going to be a very, very interesting session because over the past couple of weeks, obviously the volatility has been probably at the highest we've seen in a very long time. And today we're going to show you how you can read the data coming from the VIX to potentially leverage it for trading, whether you are a futures trader or an option trader. And together we have Joel, who's going to go through our presentation, and then we're going to go into the data. So Joel, thank you for being here. And for those who don't know you, maybe if you want to just introduce yourself, and then I can, well, actually, first we can look at the agenda, and then I know you have a slide with your bio as well. So I'm going to run that.
Right. Yeah, hi. So I'm Joel. I'm electrical engineer by school, and I've worked professionally as a software engineer for my entire career in the financial service industry, brokerage and banking. And I've been a full-time trader using MenthorQ data supporting my trading business. I've been doing that for now like a year and a half, 2 years at this point. But I've been, trading more than 20 odd years. So sort of a brief introduction to my background and what I'm doing. So we can,
right.
Yep. So we can go to the next one. Okay, so today we're going to discuss what the VIX is and how to use it and try to understand it, and to use the MentorQ data to help you view it in terms of what it is and how it relates to other products. So the VIX is the volatility index, and it's the market's expectation of volatility over the next 30 days, and it reflects the expected movement in percentage terms of the SPX over the next month, based on the pricing of SPX options. So it tends to rise when the market shows uncertainty. So you don't necessarily need to know all the data, all the things that are happening in real life. But if you just look at the data and take this data-driven approach, you can come to some interesting conclusions. So what's very key about the VIX is that it's not date specific like SPX options. It's more of a percentage based. So let's look at the next slide. Okay, so it's based on calls and puts of SPX. SPX is the S&P 500 cash index, and it's based on near the money options expiring between 23 and 37 days. So that's the VIX. There are a number of other products like VIX 9-day, VIX 30, but this is just the VIX product, VIX. So 23 to 37 days. And it uses a weighted average of the options premium and models expected volatility. So that's what VIX is. So next slide. So how it's calculated. So it's based on both calls and puts. So NTM is near the money, which is like a 0.4 delta to a minus 0.4. A plus or minus 0.4 to a plus or minus 0.6. So that's near the money. So, and then also it's based on the calls and puts at the money. So that's the price right where a spot price is trading. That's the SPX. So that's how it's derived. Next. So the VIX is a European style option, much like the SPX is. It's European style. So what does that mean? It's cash settled. So so both the VIX and the SPX are cash settled. And the VIX options have both weekly and AM monthly expirations. So you can trade it weekly if you so desire. And it generally settles like on the Wednesday before. Normally weekly options for like equities, they settle on Fridays. So why is it important? So it just helps you assess the market sentiment, and it influences the option pricing, and it's used to hedge or speculate on volatility. So that's how it's relevant. Next. So you can trade the VIX directly through its options. You could trade VIX futures, and you could also potentially trade ETFs such as UVXY. So they're all very liquid, and they're good, a good mechanism for trading. Okay, so market makers and dealers often hedge their VIX options by trading the S&P 500 options, the SPX options. So as VIX options are near expiration, hedging flows intensify, or they unwind depending on net positioning. So short gamma versus long gamma. So it's how their book is positioned, and the flows can create pressure on SPX, especially near the VIX expiry. So if there are large open interest positions, this can affect the hedging for SPX options. So you may see some changes there as the VIX expires, because generally what happens is people will close it maybe a few days before and roll into the next month. So you have like an unhinging effect, which can potentially change the SPX volatility. So that's the next one. Okay. So again, I just mentioned that traders and funds will roll the positions from the front month to the next month. So front month, the front month now would be May. The next month would be June. So that would be the next month, for example. And so when people close the front month and then go to the next month, you could potentially see some distortions in the term structure, and you and see some volatility in the SPX options as well when this happens. Okay. So one thing that's important is to know, is the VIX in backwardation or contango? So what is it? What does that mean? So the current market is in backwardation. So what is that? So for example, the May VIX is at 25. The June VIX is 24.75. These are the futures, and the current VIX is 27. So when the spot VIX is higher than the futures, that's considered backwardation, and it's considered less stable, increased volatility. So we're saying that there's more volatility today than there potentially is next month or the month after. So that's what backwardation. So contango is just the opposite, is when the current VIX, the VIX, is lower value than the future value. So you tend to see the VIX in contango in a bullish market. And you could easily look at that on your thinkorswim or whatever trading platform to know whether the market's in contango or backwardation. And so again, you can just bring up the next month contract, or you can just simply look at VXX/VXX. That's the thinkorswim symbol, to basically look at the VIX future and compare that to the current VIX. So that's a very useful data point. Okay, so Sudden moves in the SPX due to hedging rebounds, you can have a potential volatility crush or volatility spike, depending on whether dealers were long or short volatility. So when the VIX is in backwardation, VIX expiration can exacerbate the market move due to hedging. So you should track the gamma position near expiration, and we can demonstrate that on the Thinkorswim on the MenthorQ site. We can show the gamma levels. Okay. So again, we could see sudden move, strong moves using that in the SPX. So if we're looking for confluence using the data and other technical indicators, right? So for today, we'll just focus on the data and not necessarily the chart. Again, all we really needed to look at from the chart point of view was to see whether VIX was in contango or backwardation. And so that's pretty much it for that. Do you want me to? Okay, so do you want me to? I can show some of the features inside the data. We can just go over that. So, for example, right now I've brought up the VIX, and one of the things that's really very, very useful is to look at this option matrix. So we can see this is the amount of GEX that is going to expire in the various days. So, for example, very, very little until we get to the May expiration, and you see there's 112 here. Also June. So the VIX is very, very bullish, going out really out into November. But for the moment, we're really just concerned about, let's say, May, June, and July to really sort of to potentially hedge our portfolio. And again, one of the great things about it is I don't have to pick particular, if I was trading the SPX and just writing put options, I obviously can make, I can do well with that. However, it's, you have to pick the correct strikes as well as the time to be correct. Here, I just have to pick the percentage. So the VIX is, as we said, was really percentage based. So it's a bit of a game changer in terms of trading volatility. So a couple other things that are interesting. So to notice, to observe here. So if we look at the top, it's 100% of the GEX, and 38% is going to expire in May. So this is a pretty significant expiration. So if we look at it, the call resistance, so there's an expectation that we can get up to about 35, and probably will not fall below 17. So that's the view. And the high volume level is 24. So anything above 24 is viewed as bullish, and anything that's below 24 is considered bearish in the VIX. Remember, if we're generally the SPX and the VIX are inversely correlated. So VIX going higher generally implies that the SPX is going down, although that's not always the case. I've seen situations where SPX is going higher and the VIX goes higher. It's generally not a stable environment. And at some point in the near future after that, you'll see a collapse. So what I'm going to look at that I think might be interesting today is to show some other things here that are really very, very useful for understanding the VIX. So this was really one interesting data point, which shows a call wall and also shows the the range where we expect the VIX to freely move. And so we can potentially look at that. So let's see, some other things that are interesting here is, whoops. Okay, so here we can look at the smile curve. So the smile curve really just shows how the volatility is going to move. The volatility of the VIX is going to move. So we can see that we expect a decline in the VIX over the short term. So maybe within the next, I don't know, 10 to 15 days or so. This looks like it's a little bit bigger than the midpoint. So at this point, I would strategically look to go long volatility. Why? Because I expect the volatility to rise for, beyond that. So obviously it's something to monitor on a day-to-day basis, but that's what this data is suggesting. So we want to be strategic about it. Right now might be an opportunity to sell volatility, or I should say, look for volatility to decline over the next 10 days or so. So that's a way of looking at that. But notice something that's very interesting here too is that we have this big spike here. I don't know what's happening in real life. I could be, again, I don't know what the physical event is. I just know that the data is saying to me that there's an expected volatility spike. We're going to go from roughly 90% to roughly 150% within 10 days. So this is very interesting to me. And then once that happens, we should see a huge decline. So around 28 days. So this would be a time for us to take to exit that position. And then what we would look to do is reload again, a few days out afterwards. So this is probably like, I don't know, a little less than the midpoint. So maybe it's around 30 odd days, 30, 33, 35 days out. And then what's interesting to notice is that we have this nice steady state increase in the volatility through what looks like the rest of the year, frankly. So that means, long volatility is with us, and this is what we're looking to manage to support our trading thesis. So that's something else that I think is very interesting that tells us this is how big players are positioned in the market. And what's interesting is also we have this nice curve here which shows how today's VIX is moving relative to yesterday, 5 days ago, a month ago, so you can get a sense of where we are. So blue is higher relative to a month ago, so it's going to decline, but we're going to see a spike up. I think we hit a high of somewhere around maybe 50, so potentially we could get there again. So yeah, so this is another very interesting piece of data. Another thing I think that's really very useful that Fabio, you guys came out with, and I'm not sure why I don't have it here, is that you have that volatility surface. Do I need to add it to every single security?
No, just click on add command and you would add it once, and then
okay, because I added it to SPX, but I don't see it.
Scroll down to the bottom.
Okay.
Probably at the end of if you scroll all the way down to the dashboard.
Yeah, I am all the way. I am to the bottom.
Okay, then click on add command.
Okay.
And then scroll all the way to the bottom as well.
Okay. It says I have it.
Okay, so then put your cursor on the center of the screen and scroll all the way down, not on the click X there.
Okay.
Yeah, and then just go all the way down there. Yeah.
Okay, yeah, interesting. I don't know why I didn't see it before. Okay, doesn't matter. We see it now. So one of the interesting things is a potential idea to think about how to manage this in your portfolio is to think about when we're trading volatility, we were looking for expensive and cheap, relatively cheap. So these are the strike prices, relatively speaking. This is the number of days. So we want to try to sell something that's expensive. We want to have the change being short, expensive, and long, less expensive, and manage that. So we want to sell near dated, potentially somewhere around, let's say 14 days out. You would sell something like, or even lower here, somewhere around here. Let's say, one around. If you sell right around here, around 30, you have some very good convexity. So, which is very, very high here. And that's like slightly out of the money, I think. Right now, I think VIX today was trading around 27 or 28. I don't know what spot VIX is now. But look at this from the May contract. And then, just add 30 days to that. So that would be in the June contract. So that would be somewhere in here. And you could see that if you look at, roughly the 30 in May versus the 30 in June, you can see that there's a difference, very simply, 179 to 138. So roughly, 30. So there's an opportunity here to look at that, and as a calendar. So this is the high, and this is the low one. So this would be bought. This is sold. So this is how we would use that. Are there any questions with what we've gone over today? You think?
One question. I don't know if you can see the screen, Joel.
Yeah.
Amit.
At last VIX expiration, there was an expectation that market will go up due to VIX expiring. Are you able to walk through how one would look at that thesis? I think so. I think you could use I believe you could use the at-the-money term structure, and I guess if we set the date to when was the VIX? Do you recall what the VIX expiration was? It was last week, wasn't it?
April 16.
So what would we do? Set it to like the Monday before, potentially?
Sure.
Okay, so let's set the calendar to, let's go back and set to April 14th. And let's look at the data on that. So I would want to see, so one of the things you could see here is this at-the-money term structure here. And so this is the VIX on April 14th. And this is suggesting that that we would have a decline in VIX. I'm not sure if that's what you were looking for, but this is what it was showing at the time. Would that be a fair way to look at this, Fabio? Or would you see something?
I think so.
Okay, so does that really answer the question?
Yeah, let us know, Amit, if that does. And a question that I have, if we go back to last week, how do you look at the VIX expiration or also the OPEX data? Like if you look at the matrix, we can see, for example, the amount of gamma and the amount of options is expiring.
Okay,
like
so do you want me to just leave it at the 14th?
Sure.
Okay, so you can look at the option matrix, but you want to see it on the VIX or you want to see it on the SPX because they're married?
We can go with the VIX and then move to the SPX, yes. So last week, for example, was a very important week because we had a lot of gamma expiring on VIX and a lot of gamma expiring on SPX on both the, I think it was a 17th or the 16 on the VIX and the 17 on SPX.
Okay, right. That was Easter weekend. So the 16th, you had, so here, look, if you look at this simply, it's 559 million. That's total GEX, of which 185 was expiring on the 16th. So that's roughly a third. So a third of the gamma profile was expiring on this particular day. So which is actually very, very significant. So you can see, if you look at these statistics here, you had the resistance at 40. So this is where it had an expectation to get to, where it would get sold. And so the range really was 40 to 27, with the high vol level was 20. So this is where the range is, and it's basically saying that everyone was very bulled up on VIX because the high volume level was below the put support. So that really kind of gives you a simple idea about what was going on with the VIX. Does that answer that question, or do you want to look at? We can look at the SPX with the same. Do you?
Yeah,
want to Okay, so
yeah.
Okay, let's look at the SPX for the same day. Okay, so here's the SPX. So as we discussed, they're generally inversely correlated. So if you can see here that 17th, there was 200 million that was expiring of 750. So that's roughly 25% of the GEX was expiring on April 17th. So this is the weekly expiration. And again, so the range here for this was 5640 to 5200.
You want to zoom in, Joel?
Okay. I'm sorry. Let me scroll up.
That's awesome.
Is that better?
Yeah, much better.
Okay. So we can see here on the 17th, there was 200 million that was expiring, and this represents one fourth of the total amount. So a fairly significant amount was expiring on this particular day. And we can see here that the range really, based on the data, is 5640 to 5200. And the high volume level was even above that. So which look at it as that it's extremely bearish, because above the high volume level is where you would generally have the call volume. So that says to me that 5700 was sold. Anything above 5700 was sold. So that's how to look at it from the SPX point of view, or that's one way. There's obviously many ways of skinning a cat, and you can look at it from different ways. Does that answer that question, or?
Yeah, it does. Thank you, John.
Okay. Is there any other questions or anything else you want to point out that you want to go through?
Yeah, there's no question that I see right now on the screen, but yeah, I don't know if there's anything else that you wanted to point out on how you use the data. Yeah.
Again, for me, what I do is I will use this. I think what's another thing let's go back to the current day. Some other things that I think are, really very useful is to really get the profile of the GEX, and this is the entire universe of how things are situated. So again, you can see that 5400 is a very, very key level. So if the price actually goes above this, then potentially we move into a more bullish environment. But even so, you see people selling, buying puts along here above that price. So you would have to, potentially you can monitor VIX above that price, and what's happening is VIX declining, or is it or is it increasing? So that would be a useful thing to see. Another thing would be to that I like looking at, if I'm trading SPX and I'd like to get a sense of where the expirations are over the next few periods. And as we know, SPX is traded daily. So this just really gives you at a glance view as to what's happening today, tomorrow. And these are like the next higher volume days, or as you point out, GEX expiring. So 17, almost 18% here. This is actually almost the same. So, but obviously it's sorted by highest to lowest. So this is June. So again, you can see that they're all bared up here. And you can see here, some very, very key levels here, for May and June. So people generally are somewhat bearish on the market going into May and June expiration. So that to me is very, very useful as well. Another thing I think is useful is really always looking at the volatility smile. So we can see here, this generally like puts extremely high value. People are very nervous, and you can see the shape of this thing. And what's interesting to me is that this chart is demonstrating both right and left side of volatility. So like for example, this week we saw a 5% up move in SPX. So this is reflecting of the idea that people are concerned about both right tail risk and left tail risk. Obviously, more concerned about left tail risk, but right tail risk also is very, very important. And you can see that by the volatility being high, in this range. We're around 5,400 or so. So this is also a very interesting chart. And this also shows you where it is relative to yesterday, a few days ago, and a month ago. So that's another thing, the smile curve. And the other thing is I haven't really studied this at all yet, but I did take a look at this, which shows you again. We showed this chart relative on the VIX, which the idea is potentially sell high and buy low. So it just gives you also an idea of where the SPX is expensive versus where it's cheap. So this is another thing that's kind of that's interesting to look at as well. So the other things here to look at is really at a moment's glance is this liquidity snapshot showing that the market's in negative gamma. So understanding that market makers will trade in the direction of the market movement for the day. So you should expect movements to get exasperated as they push it higher or lower, depending on what the day is and how their book is positioned. So this is also a very useful detail that I track as well. The other thing I think is very interesting to look at is volume and open interest for the particular security. So you can see here, 59.90 is an area that's, seems like they're long puts here, and also here. But in the middle, so you see here that there's some call volume here around 56, somewhere between 56 and 50, as high as 58.50 or so, 59 or so. there's some strong call volume. So if the SPX manages to get through some of this, it could potentially have easy sailing all the way up to roughly, let's say, 5,900 or close to 6,000. So I would venture to guess if we looked at the, I guess the net GEX chart, we might see like 6,000 is like a key level here. Where is that? Okay. So here, like call resistance happens to be 6,000. So you can look at that from a couple of different places to, to see, key levels. So this is another way of, interpreting the data. And it's always nice when these things correlate. So any other specific, the other things here, I guess, that are useful too. Some stuff is maybe obvious or not, but this dashboard of key points, the volatility, the momentum, and seasonality, as well as the gamma condition here being negative, as well as what the expected move is. So we're seeing 1.5% move, so which is roughly, I don't know, 80 points up or down. So it's 160 points. And you can see that relative to historical volatility as well. So I think this is also, very useful to look at something at a moment. And, obviously you can do this with, with stocks as well, whatever your favorite high beta stock. One interesting one was, for me, was Netflix. They had earnings this week. They had good earnings. And one thing here, just to look at here for Netflix, and sometimes it just works. So, for example, we can see like the call resistance here for this week is 1050, and next week it goes up to 1100. So people are generally very bullish on Netflix, and then it just simply pauses for a couple of weeks. Potentially, people see it go 1150, 1200, etc. It just continues over the next few weeks. Although, you can see here, there's really not that much gamma here that's really going to potentially accelerate that move. So here, for example, a small amount. Although here for me, there's roughly 13% of the total. So if you look at that, people expect it to go as high as 1150. So, you can try to center a trade around this particular point, potentially. So, so that's just another thing to look at. Again, the same other useful statistics to help you. Some other things that I think are really, really interesting is that if you're bullish on the market, potentially we could look at a puts support screener. So this is, where spot price is near the put support. So underneath, you may, maybe you want to do risk reversal type of trade, or or just simply, sell a put spread underneath. So it just gives you, just the space, the distance from the put support. So, and then obviously you can drill down on it. So for me, I'll look at something that's fairly liquid here. We can take this as an example. Let's see. We could look at prefer to look at index type securities. It provides better risk. You don't have single stock risk. So we can look at the mid-cap ETF, and it says it's right near that put support. So we click here, we can bring up the main page for the securities. We can just go through the same kind of analysis. So if you're just looking to trade something, that's an excellent way to find potential candidates. Obviously, you have to, go through the due diligence and look through the various details here to come up with an opinion, or develop a thesis on what to do or not. So again, you can go through the same type of thing. You can see here what it's actually projecting here. So maybe if the price is, if we go above this price, maybe above 500, maybe we want to sell underneath. So you get a potential squeeze higher, and puts below will get sold and can push it higher. So something to look at potentially. Again, I don't know what the option structure is with this, what the spread is, but in general, I would look for something that's got tight spreads and good open interest. So meaning that good open interest, meaning that I want to make sure that other people are trading it so I can get in and out of it quickly. That would be my goal. Any other things you want to discuss or go through?
Let's see if there's more question, guys. But one thing I wanted to share is, let me share my screen. One second. So next week, we are going to be focusing on risk, because we listen to a lot of the feedback, and the problem is this market, Joel, have been crazy. So we've seen like 5% move in 2 days. And even if the price moves, sometimes it's very hard to really catch the move, and you maybe get squeezed into the middle and obviously lose money. If you're a futures trader, or even if you're an option trader, you could actually risk a lot these days. So next week, we're going to be focusing on risk management. We're actually going to start from tomorrow with Dan. We're going to talk about risk management with the options. On Monday, we're going to talk about risk management with Tim. And then we're going to have the session with Doc. Then we're going to talk about risk management for futures trading with Patrick on Wednesday. And then we're going to have another session with Ryan, where we're going to look at how to manage risk, look at volatility. We're going to talk about term structure, volatility smile in depth. So the goal really is to help you guys understand how you can use the data to potentially manage the risk, because that's the key part, I think, in these markets, is not think about profit, but think about how you can manage risk during volatile times and how you can benefit from that. All right. So I think I don't see any other questions, Joyce. So I think, first of all, really want to thank you, because this was great. And I think it really explained very easy and simple how to read the data on the VIX, which is key, especially when the volatility is so high. So we're going to do more of that. We're probably going to be back with Joel in a couple of weeks. Yeah, and guys, if you have any questions, please send us an email at info@mentorq.com if you want to learn more about it. And if you have questions about the session, do not hesitate to contact us. And for you, Joel, thank you so much. And
thank you.
Have a great weekend, and see you soon in the channel again.
Okay, thank you.
Have a great day, guys. Bye.
Okay, take care. Thank you.